recording here. Yeah, so we started the recording. Let me look at, this is the note that we were discussing, risk management of the corporate treasury. So you'll notice now, this is out of your folder right now, so you'll get it back out to the class. But you will notice in your student folder now, there will be a particular, because this note actually is connected to this project case. So the note is going to be located inside this folder. So let me first open the calc file. Maybe we should open this as well. And we'll keep this, we can open it later. We've got this, okay, so we've got these two, and then we will go into this. And in the meantime, we'll also open maybe the trading view. We'll leave it, we'll just leave it until we need it. So we are going inside this case project, the folder, and then we will open this, right? And maybe today we need to open this. We'll probably be using the balance sheet today. Let's look at the. It's pretty slow actually. Might as well open the balance sheet right now, and let's see where we will. Okay, so this note has been arranged. The sequence of topics arranged with a great deal of thought has gone into arranging the sequence. So we will try to follow the sequences, follow this logically as much as possible. Where are we? Outright spreads we have done. Underlying, we have just started. I think we were looking at risk books and types of risk books, and so we had a discussion of risk books. We've covered all this. And some people are still not on mute, I guess. All right, so this book's important concept to know, and right, so market and credit risk have started talking about active and passive risk books, and passive and active risk books we have defined. Let's look at your notes file, the calc file here, what we were doing. Passive, active, we have covered. You guys have to be on mute. It's too much work for me to put everybody on mute. Everyone check whether you're on mute. Okay. All right. Okay. Let's look at this. So we've done active and passive risk books. Any questions so far on active and passive risk books? You've understood. Passive risk books are run by hedgers. Active risk books are run by speculators. The main distinction is that in an active risk book, and that is connected to the definition of hedgers and speculators, in an active risk book, initially you do not have any risk because you have, let's say, a trading account or something, or you have a fund. This is, imagine, say, HDFC mutual fund before it did even one trade. All it has is the money from the investors, and that's on the asset side of the balance sheet. And then there is the liabilities to the investors. That's it. There is no risk on this book, but eventually, sooner or later, they're going to have to buy some risky assets, and that's how you start taking on risk. That's your active risk book. In a passive risk book, like a bank or a Saudi Aramco, all these cases we discussed, where these guys have already started with some kind of risk. So they can't help it just by the nature of their business. They are carrying some risk on their books. Okay, so So typically, we don't really call a bank. We don't really say the bank is as a passive risk book, because the bank also can decide not to take any risk. And in fact, in certain cases, banks do very little lending when there's a risk of credit risk, when the fear of credit risk. So bank would not be a good example. A much better example of passive risk book would be the example I gave you, like Saudi Aramco, or even the Air India risk book. Air India balance sheet with its when you start looking at its jet fuel liabilities, the amount of jet fuel it has to buy, right? So all this put together. So we'll move on now to the, let's move this here, and we've got this here, okay? So we've got this done, and active risk book, players in financial markets, underlying position. Okay, so I think we'll start here from underlying position, okay? And so we have to define now the underlying position or the underlying exposure, okay? And so remember these few things when we talk about underlying position. It's going to be discussed with respect to a market instrument combination, and it will refer to the type of exposure. So because it's a position, it can only have, so you notice how in my notes that I've given to you, I have always been consistent in the sense once a word is used in a particular way with a particular meaning, it is always used only with that kind of meaning, to denote that kind of meaning. It is not used casually in any other way. So position means it can either be long, short, or square. And many times we don't actually refer to the square part. Square is zero position, so we usually just talk about long and short. Okay, so underlying position, underlying exposure is more or less interchangeably used. So it's a type of position, so therefore it has to be either long or short. Okay, so we are always going to discuss either long or short position that some entity will have. Okay, so the position is obviously some entity. Like when you guys were running your project positions, you had, you were all basically entities. He was a natural person. Okay, Aman Agarwal, natural person, running a particular long short position, US equities. So that's his trading book. Okay, so it's a, what is Aman Agarwal's natural position with respect to, say, Microsoft shares. And then you go look in his position sheet, and you see that there is no position in Microsoft shares, or you see that there is some short position in Tesla stock, etc. That's how you discuss. So that when you talk about underlying position, you have to remember that it's always talking about the underlying position being carried by some entity. It could be a natural person. It could be a natural. We need some guys to Raghav. Okay. We need to, you guys need to be more watchful, right? I can't go on monitoring so many students. Okay. So please remember, so underlying position we are going to talk about with respect to some entity. It could be a natural person like Aman Agarwal, or it could be a corporate person or an artificial person like HDFC Mutual Fund. Okay, so either some entity, a legal person, either a natural person or an artificial person will carry this position. It will be either long or short. And it will be obviously, because remember, positions are defined in such a way that they exist in markets. They exist in markets. So, okay, so they exist in markets. And as you know, positions are discussed in such a way that it's like I lost my train of thought because I was looking at a chat message. Okay, so unless there's some important thing, don't give me chat messages. Okay, don't send like "Good morning, sir" on chat message, because every chat message I have to look up. So you do it only if there's some kind of serious problem. Okay. All right, if you face some network issues, just it's okay. You don't have to inform me. You just try to manage whatever you can, okay? Because every time you send a chat message, I'm going to look it up because I don't know whether it's important or not. I can't see the message. So, or maybe I should have the message. I need to look at the students. Okay, so let's go back to the discussion. Yeah, so all these guys, please tell everybody if you get late joining and this and that, no need to send me all these messages. chat messages. We'll see what happens about that later, okay? Because every time you send me a chat message, I have to look it up. It disturbs my flow. I've got two screens, and on one screen I've got this, whatever I'm showing you. On the other screen I've got all the names of the students. I'd like to look at the names of the students really. I can't have the chat thing up. So every time you give me a chat message, I have to go and look it up, and it disturbs my flow. So don't give me a message unless there's some problem, like you can't hear me or something like that. Okay, the simple stuff like I got delayed, network issues, no need to tell me about it. Just let it be. Okay. All right. So we were talking about underlying position, underlying exposure. Let's look at this. So underlying position, as we said, because a position has been defined in such a way that if you go back to the definition of the position, it has been defined as existing with respect to a market. It's a commitment to a market, right? So therefore, and as we also said, we never talk in the financial markets, we never talk about market prices without referring to a market instrument combination. Any price that you see is always the price of some market instrument. If you see a price for dollar yen is a market. But typically, if you see a price for dollar yen, it'll be dollar yen spot or something like that, or dollar yen forward. So that means automatically an instrument is also involved. So you will never see a price which is not connected to the idea of some instrument. Okay, there is no such price which is neutral with respect to instrument. Okay, it's a price of some instrument. So therefore, we say it's an entity's position, long or short, and it reflects. It is always discussed with respect to a market instrument combination, which means I'm going to make a statement like, okay, what is India's exposure with respect? We'll go back to our original question. What is India's exposure with respect to the spot crude oil price? Okay, I could ask you with respect to anything, but to be consistent, we will always ask these questions with respect to market instrument combination. Okay, let me just look it up here. Let me see where I've got the positions. Okay, and okay, let me try and see where I've written down the logic. There is a logic here to figure out the position. Okay, yeah, so let's look at it. We've got this here. Okay, so underlying position. So we can have that discussion once again with respect. We'll go back to remember several sessions ago, I asked you this question. Now we're going to play with that question once again. What is India's underlying position with respect to the spot crude oil price? At this point, we will open our favorite charting system and have a look at this, right? And we will also do some CP practice for you. Hopefully, we can do some of that. Okay, here we got the spot crude oil price. Okay, you can see the range of movement over these many days, okay, these many years. Okay, so let's ask this question. So underlying position, this will be always, we will be asking the question for some entity. In this case, it's India. We're asking you whether the position is long or short, obviously, and the underlying position with respect to a market instrument combination. So I'm going to ask you with respect to spot crude oil prices, what is India's underlying position? So let's look at the underlying position before we get to answering that question. Let's look at what is the underlying position, okay? So remember when we looked at these asset classes, markets, and instruments, okay? So when we say underlying, there we were talking about underlying markets and derivative markets, okay? So therefore, underlying is usually when we use the word underlying in financial markets, when we are planning to compare it with some other type of position. Like in the case of derivatives, you have call options on Facebook, and the underlying asset for that is the spot common shares of equity, common shares of Facebook, okay? Spot common shares of Facebook trading on a spot basis. So that would be the underlying, and then you have the then you have the equity options of Facebook on that underlying. So usually when we use the word underlying, then what's happening is you're looking at we are going to be comparing the underlying position with some other type of position. That's why we are choosing to use this word. So in this context, which is corporate treasury risk management, okay, we're talking about when we talk about this, so we'll be comparing it to the hedge position. Okay, so we'll let me just put this as underlying position. The next big important question is the hedge position. So here you saw all that long hedge, short hedge stuff, which is coming up in the Hull book, which we were discussing last in the other in the previous class. Okay, so well, let's give us the definition before we go to India's exam in the discussion of the India problem. So I'm going to give you more of a theoretical definition of underlying positions. So you know that it has to be a position, it has to be with respect to some market instrument combination, and it has to be either long or short, and it'll be held by some entity or the other. Okay, and then you see here, so we're defining it qualitatively. All the stuff we've already discussed, and you can see the qualitative definition. Okay, positions that exist. Okay, nature of the entity's business. Now, generally, since we are doing corporate treasury risk management, we're talking about non-financial corporations usually in this risk management context, non-financial corporations. So we're not talking about JP Morgan or something like that. And that's why I did not want to talk about this example of a credit risk portfolio as being that of a bank. Okay. Because typically we want to really understand the best way to understand or the more common way to discuss corporate treasury risk management is to discuss it with respect to non-financial corporations. So in this context, we'll be talking about entities which are not banks, preferably, okay? And that will help to bring out the idea of the hedge position much more clearly. All right, so hedge existing because of the inevitable consequence of the nature of the entity's business. So if you remember yesterday in the previous class, we had a pretty long discussion on Saudi Aramco and its position with respect to crude oil, okay? And so if you remember, I would have used the word several times and I would have said that Saudi Aramco is long crude oil, yeah? I would have said long crude oil several times without really explaining to you the logic. Because you're not supposed to memorize stuff. You're supposed to think logically and figure it out. But I would have used this statement saying Saudi Aramco is long crude oil, okay, many times. So let's try and understand this definition a little bit more, okay? Here, so I've given you further examples. I don't know if you guys have done enough reading to understand, but Norway is a major oil exporter, okay? Very big oil exporter. That's why Norway has a big sovereign wealth fund, which is all funded by this is all North Sea oil, that side, where all the Britishers also, the British also have some oil from there, okay? But it's kind of from that area, okay, you know where Norway is. So Norway has a big oil position, big oil reserves. So they are a natural oil exporter. So here also we say that Norway is long oil, okay? And in this case, Barrick Gold is a very big gold mining company. So here we talk about Norway's position, we say, is long in oil. Barrick Gold's position is also long in gold because these guys own gold, okay, due to its mining operations. So what we're trying to hear, by the objective of giving these examples is to bring out the qualitative nature of what we call the underlying position in the context of risk management, okay? So remember that this term underlying position, okay, or the word underlying, okay, is also used in derivatives trading, but there it is referring to the underlying. So if you're trading like Tesla options, the common stock of Tesla will be the underlying. So you have to remember the context in which the word is being used. Here we are discussing corporate treasury risk management. So therefore, in that context, underlying has a different meaning, okay? It is usually a position, whereas in the case of any other derivative trading situation, the word underlying will be referring to a particular asset, okay? And you may have a long or short position in that asset. So you have to be careful about the context. Okay, so here we'll be talking about underlying position, and you can see how we're bringing out the qualitative nature of the definition. That what is the meaning of the statement here? Positions that exist on the books as an incidental but inevitable consequence of the nature of the business, which means Barrick Gold is a gold mining company. There, as we explained to you the other day, we talked about the value chain. Now, Barrick Gold is not in the business of speculating on the gold price, because there is no need to, if you wanted to speculate on the gold price, there is no need for you to run gold mines. Running gold mines is a very complicated operation. You have to deal with the labor, you have to take all the environmental regulations into account, and then you have all the natural disaster risk. It's a big operation. It's a very messy operation. These guys operate all around the world, sometimes in not so stable political environments, okay, like in some African countries. And so therefore, it's not worth all the hassle. If you want to speculate on the gold price, there's very liquid markets in the spot OTC markets for gold. The same banks who trade in foreign exchange will, many of them will quote you gold prices in the spot market. And then you have very active gold futures on the CME, which you guys will be trading. Okay, so it is much easier to hit the futures price if you want to take a view. It's so quick, it's so efficient, and there's no need to worry about all these physical gold mines and managing the inventory, packing all the gold. It's a mess. So they are not in the business of speculating on the gold price. They are actually in the business of extracting the efficiencies in the value chain of the whole journey of gold, all the way from the being buried in the mountains and the walls and dug out and then carved into gold bars and sold to jewelers and other people like that. Okay, that whole process, that entire long process, many steps in the process, and these guys are masters at squeezing out all the little efficiencies, cutting the costs here and there, and improving their operating margins. That is what businesses do in each industry, okay? And therefore, there are some positions though, but Barrick Gold, for instance, because it's in gold mining, it's always getting gold out of the ground, and it has always got all kinds of inventory in gold, maybe some raw material, maybe some work in process, some finished goods. You can't help it. You can't sell as the inventory comes out. The selling cycle is different, so it's got a different rhythm to it. So you're going to have a mismatch. Many of you come from business families. You know how businesses operate, especially production businesses. The inventory will keep going up and down, and you can't really control the accumulation of inventory because it depends on the selling cycle, which is unpredictable. So therefore, because of their position, so they're stuck in gold with inventories, and if the gold price goes up and down, the value of their inventories is going to be changing, and then the accountants are going to come and say, you need to mark down the value of your gold, etc. So this is how it works, okay? So to give you a very good understanding of, because you'll be doing a project on this, understanding of underlying position and underlying exposure, okay? Right. Now, so therefore, underlying position being a position must have a direction and a magnitude, either long or short, by some number of units. Okay, so that's another problem, that in the case of positions, okay, it's going to be either long or short. And I'm not going to be asking you here about I'm not going to be asking you about the units because we don't know the total volume in this case. But in a particular case, when you're applying this logic and looking at a specific situation, you will know the units as well. Okay, so here the question is, how anybody wants to tell me what India's underlying position is with respect to spot crude oil?
Short.
Okay, who is that?
Short.
Here, see, who said that? Short?
Vipul, sir.
Vipul, okay, 1 minute. So Vipul is saying short. Now, why is Vipul saying short? Okay, 3 participants have raised their hand. Maybe I should have the participants also out here. Okay, let's see. 3 participants. We have many participants around. So Vipul, what is your answer? What is your logic? Why is India's position short? So after Vipul, we'll go to Srishti, then Krish, and I think AA also had raised his hand. Anyway, so we've got, after Vipul, we'll go to Srishti and Krish. Yes, Vipul, what is the logic for your answer? You're saying the answer is India's position with, India's underlying position with respect to spot crude oil, you're saying is
Short.
short. Okay. Now, what is the logic for your answer? Why is it short and not long? Tell me.
Sir, as per I don't know the sir, particular logic behind this. Once you told in the class that it is short, so that's why I remember.
Okay, okay, at least good. At least you remember what I said. Okay, that's good. Okay, fine. 1 minute. Okay, fine. No, sorry, I'm not trying to make fun of you. Okay, don't be offended. I'm just laughing just like that. Okay, so I
No
won't get
problem.
offended. Okay, don't get offended. Okay, so okay, sorry. Where is now? Krish has disappeared. Krish had raised his hand. Now he has disappeared. Okay, now Srishti, what is your answer, Srishti?
Sir, India's position with respect to crude oil is short.
Okay, why?
Sir, I don't know the logic once you told in the class that it is short.
Okay, fine, no problem. So you're also like Vipul, you're saying, okay, that's good. At least you remember that. That's fine. Okay, no problem. Yes, next is Sachin.
Just short because sir, in this we need to hedge the fund to raise to cover the price to cover the we need to hedge the fund to raise the cover the crude oil position.
Sachin, you need to work on your oral communication. You cannot go to an interview and talk like this. And all the again, by the way, please. I may be criticizing many of you here and there. Please don't get offended. I'm criticizing, let's say, whatever Sachin is saying. I'm telling him to improve his oral communication. He should not get offended. I'm doing it in front of the whole class, but we are like a team, okay? And I'm like your coach, so nobody should get offended. But I have to tell you when I know that there is something that needs to be improved, okay? You have to speak in much more clearly. What you're saying doesn't make any sense, actually. I know what you're trying to say, but the interviewer is not going to know what he's trying to say. No, and my job is to get you ready for the interview. Okay, so if I am not going to fire you when you do something which is not good enough, then you're not going to improve. So it's my duty to inform you that what you just now said is not good enough. I understand what you're trying to say, but you got what I'm trying to say. You need to improve the way you
Yes, sir. Yes.
You got it?
Yes, sir. Yes, sir.
Yeah, you have to improve. I don't know what you're trying to say, but I mean, I think I know, but you have to work on making it clearer what you're saying. So what is it? Can you repeat it once again? Can you try to explain it better to me and everybody else?
Sir, in this we need to go short because sir, in
No, 1 minute. I'm not asking you whether India needs to go short or long. I'm asking you, what is India's underlying position with respect to crude oil, spot crude oil? I'm not asking you whether India needs to go short or long. That's a secondary, that question can come later. First, then I'm asking you, what is India's underlying, you're looking at India, you know what India, I gave you some examples of what is Norway, what is Barrick Gold, what is Saudi Aramco. We discussed some examples, right? So here we don't know what Norway is actually doing. We don't know whether they need to buy or sell or whatever we haven't gone into that question. That's a second level question. We are asking a first level question. What is India's underlying position with respect to gold? With respect to spot crude oil. Yes, Sachin? Your answer is what? Short.
yes, sir.
Your answer
Because
is
sir,
short.
sir, I think in this the role comes to a hedge fund to cover the
But your answer, Sachin, is long or short?
short.
Short. Okay, now
Yes,
you
sir.
tell me why. What is the answer? What is the reason?
Because sir, in this we need to hedge the fund to cover the price. That's why.
You need to hedge the. Okay, fine. So we'll leave it there. Where is the fund coming from? We are talking about India's exposure. Where is the hedge coming from? Where is the fund coming from? Okay, we'll come back. So you need to work on this. You need to work on your expression. Okay, you need to polish it because you're doing good work. I can see you're studying seriously, but you need to improve your oral communication. Otherwise, in an interview, people will have a poor impression of you. Okay, it is not fair actually, but this is how people judge people. The life is what it is. Okay, so you have to get ready for that. Okay, Utsav, what is your answer?
Sir, my answer is also short, but the logic that I have followed is somewhat different. It is that India will gain when the oil prices are down.
Okay.
And India will be at a loss when the prices of the oil in the market are going up. So by that logic, I think it is short, since this type of direction in the market is followed when somebody has a short position.
Okay. Okay. Good. Then anybody else? What about Krish? Krish had raised his hand. Where is Krish now?
Sir, I am here only. Sir, my answer was short, but the logic I was confused between.
1 minute, 1 minute. Where is this? Who is speaking now? Krish?
Yes, sir.
Okay. So you raised your hand and then you lowered your hand.
Yes, sir. Actually, the reason behind the positions, I got confused in that actually. That's why I pulled down my hand. My answer is actually short.
Answer is short. Okay.
Yes, sir.
Okay, 1 minute. Okay. All right. So Utsav has given a very good answer actually. So Utsav has given the right logic, the right answer, and you have to understand obviously what is the logic. So even without knowing the position answer, the actual answer, whether it's long or short, comes later. First you go through the reasoning, and then the reasoning leads you to the answer, obviously. Okay. But what this requires is that it requires some knowledge. Like if I just ask you, what is, let's say, Mexico's, I've told you about Mexico as well. But if you don't know about what Mexico does with respect to oil, if I just ask you what is Mexico's underlying position with respect to spot crude oil, if you have no idea about the Mexican economy, you won't be able to answer it. You need to know something about that situation. Okay. So like Barrick Gold, you need to know what Barrick Gold's business is. Okay. So you need that knowledge, but everybody knows that about India. So that knowledge with respect to India, everyone here has. So what the logic that Utsav has given is the right logic, which is very good, which is this is how you figure out. Okay. That how do you know what the underlying position is? Okay. This is how it is done. Okay. I'm trying to maybe make it F11 so we can have a little more view, and I will reduce the zoom also so everybody can see. You can still see the font size, right? Yeah.
Yes, sir.
Yeah. So now you can read this. You guys, everybody can read this and see. While you're reading, I'll take a sip of water. Please read this thing logic properly and read the logic and try to understand it, because there's no point my reading it out. It's there already on the board. Like this is something else you should know when you're presenting. We keep telling students, but I still see lots of people making the mistake. When you're making a presentation, I've seen even Harvard professors actually making this mistake. You've got a bunch of stuff on your, say you've got stuff written on your slide. Okay, Srishti Gupta, Utsav Maharishi, Varun Jain, Vipul Jug, names are written there on the slide. Then you don't go and when you're presenting, you start reading Srishti Gupta, Utsav Maharishi. This is not the way to present. You just say, okay, you see those names on the board. Now we're going to tell you something about these students, etc. This is how you talk. Okay, so just read what's on the screen. Okay. Okay, so the entity PNL. So the keyword is happen. Happen is basically trying to capture the effect. Okay, what is the effect on the entity's PNL if the market went up? Okay, this is how we should think about it. And happen to the entity PNL if if the market went down. Okay, so went down. Market went down. Okay, and here I should assume that profit and loss account, I should add this other statement, which is assuming constant M to M of all assets and liabilities. Okay, constant mark to market of assets and liabilities. Now, what is the connection between PLN and assets and liabilities? Because assets and liabilities exist on the balance sheet. Okay, and the PNL is obviously a PNL. It's a different kind of account. But the problem is that whenever there is a hit, as you guys, I don't know if you guys have done this, that you did the statement of changes in shareholders' equity. Did you guys do that in your in accounting?
Yes, sir. It was a part of the financial statement.
Correct. Very good. So, statement of changes in shareholders' equity, if you remember, even in your first case of Smoky Valley Cafe, okay, you can actually take any P&L. There are some other sources of impact on statement of changes of shareholders' equity, but statement of changes in shareholders' equity, but the main impact comes from the period P&L. Okay, so your period. So if you take only the impact coming from the period P&L, so the period P&L will basically, if it's a loss, your shareholders' equity will go up. It will go down, and if it's a profit, the shareholders' equity will go up. Okay, if you ignore some of the other like asset revaluation, this and that. So essentially, you can also take the other side of the thing that if you take this, if there's any, you always assume that profit and loss, the entire balance sheet is being constantly marked to market. It's not possible to do it, but you have to imagine that it is being done. As market prices are changing rapidly, the balance sheet is being constantly marked to market. And another thing is that we'll talk about this a little bit later. Maybe I'll write it somewhere else. That there is a, this is an economic balance sheet actually. Okay, all asset and liability. Let me write it here. On and what we call it, economic exposure, not exposure balance sheet. Okay, not just an accounting balance sheet. So what we mean by economic exposure balance sheet is that on an accounting balance sheet, we only show what is actually there. So if India has right now, maybe, let's say we are not a good example actually. Let's look at, say, Saudi Arabia or somebody. They have certain amount of barrels on, let's say, the Saudi Aramco balance sheet. The accounting balance sheet will actually show the actual barrels of oil that are there right now in inventory. They will look only at the actual figures, okay? But if Saudi Aramco is drawing up an economic exposure balance sheet, okay, that is a, let's really put on constant mark to market, okay? That's the thing, okay? If Saudi Aramco is drawing up an economic exposure balance sheet, what they're going to do is, let me go back here. Economic exposure balance sheet, you will have to do it this way. So you are going to actually project, like, say, maybe Feb. Actually, I should do it this way. Feb, March, April, so on and so forth. Okay. What is this doing? In this manner, okay? So they'll say that maybe 500 million barrels coming out of the ground and getting ready in February, 650 getting ready in March, okay, 750 getting ready in April, let's say maybe 350 coming on stream in May, then 210 coming on stream in June. And so they're going to be looking at the entire exposure. Basically, they're depending on their hedging horizon. So the main idea about the economic exposure balance sheet is that you don't just look at the current figure. You know that because you're going to be operating as a going concern, you need to worry about these future liabilities, or in this case, these are assets for Saudi Aramco. Okay, so they have all this oil likely to come on the books. They know the production schedule. There is some a regularity from year to year. They know how much oil is going to be produced, what is the pace of production, etc. So they're going to be basically planning for the entire. They will be this. This is actually a function of the hedging horizon. Okay, how far out they like to hedge. So they will look at all the stuff that's coming on board, all the material that's going to, all the finished goods inventory that is going to come on stream, going far into the future. And that will be treated as the sum of that will be your economic exposure. Okay, this is what I mean to say by economic exposure balance sheet. And then you'll put it on the balance sheet as something that has to be hedged. So that's not an accounting balance sheet. Nobody would do an accounting balance sheet like that, taking into account future production. But this is what you have to do when you do actual hedging, because you have to look at the economic exposure, but because the accounting balance sheet is only showing the current exposure. Okay, so this is something else that you have to think about. Let's put today's date here. Today is no, can't do that. What happened here? Okay. Right, so that's economic exposure balance sheet. So let me make that little change here. Okay, economic exposure balance sheet, not just an accounting balance sheet. So constant mark to market economic exposure balance sheet. So in India's case too, also we would have to actually do the same thing, kind of exercise. We're not just concerned with what we have to buy right now. We are to be concerned with all the stuff. So whatever India's hedging horizon is, okay. I've written an article where I've recommended that we should hedge till about 5 years. Okay, India should be hedging its oil price exposure for about 5 years out. So you would lay out the entire monthly purchase schedule, and we know roughly how much we're going to buy in each month. We have a pattern because the economy doesn't change that rapidly. So we know the pattern. So we would line up the entire 60 months, okay, and that would be the economic exposure, and also split by month. We look at the total and also look at the monthly splits. Okay, so also be aware of the monthly splits. So this is how you would do the economic exposure balance sheet. So when I'm talking about this, I'm talking about the P&L. What are we talking about the P&L? If the P&L is assuming that there's constant mark to market of all assets and liabilities on an economic exposure balance sheet. Okay, and so go through the full logic. If entity makes money and entity loses money, if when the market goes up, the entity makes money, and when the market goes down, the entity loses money, then the answer is long. Because as Utsav correctly pointed out, so he has correctly got all the elements of the logic, which is that why are we saying that the answer is long? Because only a long position exhibits this type of behavior. Think, what is the type of behavior? What is happening? The market price is going up, the entity is making money. And when the market price is going down, the entity is losing money. What is the type of, only the long position? Remember, position can only be either long or short. So which type of position behaves like this? The long or the short? And the answer is the long. Only a long position behaves like this. Therefore, that entity's market price, underlying position in that particular market instrument combination must be long. Okay, has everybody understood now what the logic is? So obviously you have to understand the business. So if I give you Japan's underlying position with respect to crude oil, you have to know that Japan is a net importer. Okay, that you have to know. If you don't know that, then you won't be able to answer it. Okay, but once you know that, then you can figure it out. So Japan's situation is the same as India. If you have to figure it out this way, that if the spot crude oil price goes up, what happens to Japan? And if the price goes down, what happens to Japan? Well, they lose money in the case of price going up, and they make money when the price goes down. Therefore, Japan's position must be short, because only a short position exhibits this type of behavior. Okay, yes, Krish, yes, what is your point?
Sir, can we say that the country who imports more crude oil has the short position and countries who export has long position.
Yeah, that's what we are saying. So I thought you initially said import. Yeah, I thought you were saying more. Yeah, so that's exactly what we are saying. Because if you apply the same logic in the case of Mexico, which is another big oil exporter, okay.
Sir, I did the same logic, but I was confused at that time actually when India's position short was.
Okay, that's okay, no
I
problem.
got this point.
It's a new concept.
Same wise, yes, sir. Same wise, the Iranian national Iranian oil company would have long position.
Correct. They would have a long position. Okay, so very correct. So all oil exporters will be long, because when oil prices go up, they make money. When oil prices go down, they lose money, right? Because they can actually revalue their. What will happen basically in the case of all these oil exporters, when you'll have to basically mark down the value of all your future positions also, because you can look at the futures curve. If you remember, we have somewhere here we have the crude oil prices. You can see the entire futures curve. Okay, so all this futures curve, you can actually apply February contract against the February position. You can apply the May contract prices against the May position. When the curve moves, it moves not exactly in the same way. Like if spot prices go down by $10, that doesn't mean that the May price will go down by $10. It may go down by maybe 8.5 or something like that. You don't know how much it's going to go down. It is impossible to tell. So, but it will go down by a little bit. Okay, if spot goes down by $10, unlikely that May will go up. It will tend to go down, but how much we don't know. So you can see how the curve keeps balancing. So once you start looking at futures and options, you've already traded options. It's much more complex, because you're not dealing with one spot price. You're dealing with all different prices for different maturities. So it's a much more complex situation. Yeah, so you're right that it is basically all the oil exporters will be naturally long oil. So sometimes we also call this the natural position. This underlying position we sometimes also call a natural position, right? That, but better to use the word underlying position. Okay. So sometimes we call it a natural position or a structural position, etc., etc. Okay, so we can maybe move this down a little bit, give you a little bit of space to see things. Okay, all right. So this is basically, now you got the logic. Figure out, you need to know what that is. If I ask you about the UK, for instance, what is the UK's position? The UK has oil in the North Sea. They are also an exporter. Okay, so they will. What is happening here? Yeah, okay. Yeah. So please keep your messages about not getting disconnected and all that. No need to post those messages in the chat, okay? We'll figure that out later on if you have, because the chat transcript is also saved, so we can look at it later if we need to. In general, don't give chat messages unless you need to have there's something important that, like you can't hear me or something like that. Okay. All right. So this is your. So I hope everybody does. Anybody have any question now as to how to figure this out? If I ask you about any entity, assuming that you know what they do, okay, then what will be their exposure? Will you be able to figure it out? Let's ask Ummat and find out if he knows. Sterlite Industries. Do you know a company called Sterlite Industries, Ummat? What happened? Ummat is asleep. Still sleeping. Okay, 1 minute. All right, so let's see who else is still sleeping. Okay, let's ask Varun. Yes, Varun, do you know a company, Indian company called Sterlite Industries? It's owned by Anil Agarwal. So maybe we should ask Nikita and Raghav, all these people, Rishabh. Yes.
Yes, sir.
No, no, I'm asking Varun first.
Okay.
I was just joking because your surnames are also Agarwal. Okay, yes, Varun. What happened? Varun is also asleep. Okay, so all right. Okay, let's ask all the Agarwals. Nikita.
So it's a subsidiary of Vedanta Limited,
Good.
and it's into like metals, copper and all, I guess.
Yeah. So what is Sterlite Industries? It's a copper position.
Copper, it manufactures copper.
Yeah. Yes. What is it, Nikita? What happened?
So what's your question?
Yeah. What is Sterlite Industries' underlying position with respect to copper? Spot copper. Is it long?
So I think it's long, but I'm not sure because I didn't follow the logic correctly.
You didn't follow the logic. Then you should have asked me the question. No. You read the note. You read what is.
So actually, I'm facing a lot of network issues, so your voice was breaking again and again. That's why I didn't ask earlier.
Can you see the screen? Can you see the screen?
Yes, sir, I can see that.
Please read. Everybody, please read. Okay. While I ask all the Agarwals, since this is owned by Anil Agarwal, we are going to ask all the Agarwals. Okay, Rag, you're next. Yes, Rag. What happened to Rag? We are coming to Harsh. 1 second. We will go through all the Agarwals. Where is Rag?
So it's long.
No, that's okay. That's long. Okay. But I'm just now. Where is our friend Rishabh Agarwal? He's also sleeping. Early morning, first class, everybody's sleeping. Lots of sleeping people. Okay, 1 minute. And so, Nikita, you want to give me some logic? You said you're not following the logic clearly.
Yes, sir. Yes, sir, I just read it and I understand that they manufacture copper. So if the market went up, if the copper prices went up, their PNL, I mean, they will make more profit.
Okay. And?
So the entity makes money, and if the market went down, the entity will lose money. So that is possible only if it has a long position.
Okay. Okay. All right. Okay, good. Okay. Now, so we have already, now Nikita's already given the answer, so we can't ask other people. I guess we'll let the, yes, but we had some other hands up. Let's have a look at Harsh. Yes, Harsh.
Sir, I had the same answer.
You have the
So
same.
yes, sir.
Okay. And double A?
Same as Nikita.
Okay, 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 fine, no problem. Okay. One minute. All right. So, so I think now you understand the logic that has been given based on what we have read in the note. Okay, and so this is an important skill to acquire. That in any situation to be able to figure out where for any given entity, what is the let me set your class alarm. Actually, I forgot to set the alarm for any given entity to figure out what is the underlying position with respect to any given market instrument combination. All right. Okay. So, so this is an important trick because in order to manage a hedge book, you have to first understand what the underlying position is. So this logic is actually not explained well in the Hull textbook. He just goes straight onto the idea of a long hedge or short hedge. And so this idea that this is important to understand in any given situation. Okay, how to look at a long underlying position, long or short. Okay, and then we look at one more theoretical concept, which is the concept of a key risk factor. Okay, a key risk factor is a price. Okay, so this is going to be a price. And this should be always market instrument combination. Whenever I write market, actually wherever you see market, it is to be read as a market instrument combination. So sometimes I may forget to write because it's always a market instrument combination. Okay, so it's not just a market, it's always a constant combination. So you would say spot currency markets or currency futures markets or currency options markets, etc. Okay, so it's a price. Changes in that price will cause changes in the value of assets and liabilities. Okay. That's a key risk factor. So another term we are introducing, first we introduce this term called underlying position. Then we are going to introduce this term called key risk factor. We'll quickly explain now with respect to, we'll go into the case itself, okay? And the key risk factor is related to the underlying position. So key risk factor in this case, for instance, to give you an example with respect to the discussions we already had. Now in the case of Sterlite Industries, which runs copper mines, so there for them, when you're talking about their balance sheet, at least one of the key risk factors is going to be the spot price of copper or copper futures prices. Okay, so you can decide which ones to focus on. You can look at the spot price, or you can look at the entire term structure of futures prices. So those will be the key risk factors. Okay, because it changes in those copper prices or the futures prices for copper, or the spot price for copper, which will also lead to changes in the futures prices. That will change the value of all the copper they have. If you see the economic exposure balance sheet of Sterlite Industries, they will have copper coming on stream Feb, March, April, May, June, etc. And they'll be looking at the entire sum of all that. So as prices of copper futures go up and down, all these future production, remember this is quantities, okay? This is, you can look at it in pounds. So copper futures are trading in cents per pound. So you look at it in pounds. Now all these are pounds, but you have to multiply it by, or maybe like these are not just, they will be much more than this. So it is maybe in thousands of pounds, okay, these units. So thousands of pounds, so all these pounds that are coming on stream, all the futures prices you will have to apply. So what you're going to do is, if you look back here, we'll come back to key risk factors. Somewhere here we had these, do I still have, yeah, we have all these things, right? So we look at the copper prices. So what's going to happen, the way it works is, let's understand the meaning of a key risk factor. So it's easier to look at it by considering futures prices. Normally, sometimes we say spot because when the spot changes, the futures will also change, okay? So it's not that the futures will remain unchanged when the spot is changing. So let's look at the quotes. So we use this futures as a kind of proxy for the whole curve, okay? And because we use the futures as a proxy for the curve, because if the futures moves, generally the curve is also going to move pretty much generally in the same direction, okay? Okay, so here you have this, okay, and here you can put a cash market price, the current price. And so you have the most recent price, and then you have all these prices. So what you're going to do is you take 1852, okay, this is cents per pound. This is to be okay. Now you see this, you will apply it for the Feb price, you will apply it to the Feb position. The March price, you'll apply it to the March position. You can see it's a little bit different. You can see the curve is in contango. Remember these terms, futures and backwardation and contango. The market is, the curve is clearly, so we refer to this as a futures curve, okay, which is basically the term structure of futures prices. And you can see there is a slight contango in the curve. Not a very liquid market, because we are also outside US trading hours. So not a lot of activity. This is not so actively traded. If you look at the oil price now, this will still be actively traded because oil is much more liquid than copper. So you will be looking at all these prices, and you will take each of the month's prices, the April price, and you'll apply it to the April production coming up. And then you'll get these two, multiply these two, you'll get a value, and that's the value of your April production in the future. Okay, and then you'll add up all these, and then you'll get that total value. And as in an economic exposure balance sheet, if the April price drops by 3 cents, or then the total value of your future position is also going to go down. So your asset value is going to go down, and that means that you're suffering a loss. So this is how it's going to be tallied. So that's why we would say that these futures prices are key risk factor for the Sterlite balance sheets. For the Sterlite balance sheet, one of the key risk factors is going to be the futures prices, and then they may have all kinds of other exposure on their balance sheet. So the other term that we learn is key risk factor, which is any kind of market price in a market instrument combination context, where changes in that price is going to cause changes in the value of assets and liabilities on the balance sheet. So it's very closely connected to the underlying position, because you will be selecting the key risk, you will notice the key, or you will detect or identify the key risk factors pretty much around the same times that you will be identifying the underlying position. Okay, in the same way, when you answer the underlying position question, when you figure it out, you will also figure out the key risk factor. Okay, so for instance, in the case of India and the oil price that we looked at, if you discuss India's balance sheet, you will say that one of the key risk factors is the spot oil price, okay, or the term structure of futures prices for oil, because it will all affect our asset, it will affect our liabilities. Because in the India case, our future purchases are going to be shown as liabilities, because these are all monies that we have to pay to buy these amounts of oil. So it will show as our liabilities, and the changes in the oil price, it's going to be affecting our liabilities, because if the oil price goes up, the dollar value of our liabilities will go up. The quantities to be purchased remain the same, but the price goes up, so the total value goes up. And that therefore oil price is a key risk factor for India's balance sheet in this kind of context when we discuss it. Okay, so here, and you can see again, in the case of options, each position has at least 2 KRFs actually, two major KRFs. Okay, this is a little bit of a superfluous statement, because key itself has the sense of being major, but we are saying major KRF, or let's put it this way, important KRFs, slightly less superfluous than major. Okay, what is this? This I think is Merriweather. Let me change the. And what is the font size? This is 14. Maybe it's not, should not have been Merriweather. I don't know. Or anyway, so we'll worry about the font. Okay, so remember, this is a very important design issue. You should not use differential fonts on a page. I think I've told you this before. Those of you who are ever going to be ever designing a market brochure, do not make this mistake. The 2 types of fonts should never be used in one view where the customer has to read. It creates visual dissonance, so you should not do that. Font size can be varied, but font type should not be varied. Okay, so you understand now the other concept of key risk factor. In the case of options, you will have to deal with the underlying asset, okay, the underlying asset price. So if you're trading Facebook options, your key risk factor is of course Facebook stock, the common stock price, but also the eyeballs of Facebook. that becomes another important factor because the option price is mainly being driven by these two. Of course, there are other factors as well. That's why I use the word key important, because it's not correct to say that two KRFs, because even the interest rate can affect the option price. So there are other factors, but the key factor, the two real important factors we worry about when trading options is underlying asset price and the eyeball movement. So therefore, in this case of options, we have two KRFs, two important KRFs, which is underlying asset and eyeball, right? So market instrument coverage, etc., etc. Now, let's look at the other concept that we have to look at. Let's read this also. We are discussing a third concept. Okay, let's I think at this stage, let's introduce the, let's go through this first, and then we'll look at introducing the case. Okay, let's look at this. Maybe you guys can read it again. Read this a little bit. Let me make this full. And so now we went through underlying position, and then we went through key risk factor, how to figure out the underlying position. We understood the key risk factor, it's a pretty simple thing. Then we are talking about the hedge transaction and the hedge position. Okay, let's try to understand that. Okay, hedge transaction and hedge position. Try to read this on the screen. So this stuff that you're reading here now, this again, when you read all this, and then, so here I've provided to you the theoretical framework for understanding what happens in a hedging situation. So underlying position, then key risk factors and hedge position. Once you read all this, when you go back to the Hull book and read those short hedge, long hedge, those things will make a lot more sense, because now you understand the theoretical background and the logic. Most important is the logic. You see the logic here, right? So hedging, you have to always remember, the objective is to reduce risk or totally remove the risk. Therefore, and the objective is to bring certainty to future cash flows. Okay, so how do you do the hedging? You do it through executing hedge transactions. So here now you'll notice here I'm very particular about the use of words. We don't, so this is along the lines of how, so I was telling Sachin earlier that, you know, when you speak, you have to speak very carefully, measure your words, you have to use your words very carefully. So I would like you to make sure that you do not use these terms in an interchangeable fashion, okay? A hedge transaction is different from a hedge position. A hedge transaction is a sale or a purchase. A transaction is either a sale or a purchase. The position is either long or short. Okay, so don't say position when you mean transaction. So sale of dollars and purchase of CHF, which is Swiss francs. Okay, remember Swiss francs is CHF because the country, the official name of Switzerland, like ours is Bharat or Hindustan, the official name of Switzerland is Confederation Helvetica. Those of you who did stamp collecting when you were kids, you would have seen that the Swiss stamps, they have Helvetica written on them, Confederation Helvetica. That's the official name of Switzerland. That's why their currency is called Confederation Helvetica franc, CHF. Okay, so this is sale of USD, purchase of CHF. That's a transaction. And position is short or long. So when you do this transaction, you end up with this position. Okay, so you have to understand one thing here. We are defining hedge transaction and hedge position. Okay, now you know what, once you get the underlying position, how do you figure out what hedge transaction needs to be done? That you figure out by working backwards from figuring out, first figuring out what is the hedge position that I need. if this is my underlying position, what should be my hedge position? You figure that out first. And then you say, okay, if that has to be my hedge position, then what hedge transaction do I have to do? That's how you should work it, okay? And then you go out into the market and you do the position. Because remember, in the market, you can't just go to the market and say, I want the hedge position. You don't talk like that. You say that I want to sell dollars and buy Swiss, okay? So, and then you end up with this position. So that's how you go logically. Figure out the underlying position. No, this is how the logic works, stepwise. Figure out the underlying position. Okay, then what happens? You know that when you're hedging, the objective is to reduce or eliminate risk. As a hedger, once you understand that you're a hedger, you determine your hedgers, like in India's case, if you're hedging India's crude oil, if you're running the crude oil program, crude oil hedging program for India, you look at the Indian economy, you look at the resource endowments that India has, you realize that India does not have enough oil for what it needs. So India is a net oil importer. Therefore, you realize that India's underlying position with respect to crude oil is short. And then you say that, okay, India, in this case, we are running India's hedging program. We're not running a speculative program. So India's underlying position is short, and we are running a hedging program. So the objective of a hedging program must be to reduce or eliminate risk. So if my underlying position is short, then I must create a hedge position, okay, or do a hedge transaction such that it creates a hedge position, okay. That hedge position, the rule of a hedge position basically is that the hedge position must be opposite to that of the underlying position, because the hedge position will achieve the hedger's objective, that is to reduce or eliminate risk, okay. So now if reduce means you maybe if your underlying position is short 100 million barrels, you do a hedge position where you go long maybe 70 million barrels. So you've reduced your underlying position or risk, but you haven't eliminated it. Eliminate means you do the same volume. So if you're short 100 million on the underlying position and you buy, you put on 100 million long hedge position, then you have eliminated the risk. Okay, if you use that term, remember that Hal has used in his book, hedge and forget. Now you can go home because you've already eliminated the risk fully. Okay, so this is just nothing but 100%, and this is less than 100%. Okay, so you determine the hedge underlying position first. India is a short crude oil. You know that India is hedging, so India must reduce its position. So therefore, India must create a hedge position which is opposite to that of the underlying position, and therefore it should be a long hedge position. Okay, in order to create a long hedge position, it has to do a long hedge. Okay, which means it has to buy crude oil and sell US dollars. Okay, so again, remember this concept here we can use, taking the example of India. We can once again go back and refresh this idea that when you're running India's hedging program, you are supposed to look at your risk in two parts. You have in the crude oil market, you have crude oil is trading against US dollars. All this stuff you see, 65, whatever, $75, etc. All this is US dollars per barrel. Okay, that's what you have. Now, so it's 75 US dollars per barrel. So you're basically, so you have here, you have oil and you have USD. And also in India, what do we have? The Indian government has, of course, we have foreign exchange reserves, but in our accounting, when we do our accounting, the Reserve Bank of India balance sheet, let's assume that this is put on the Reserve Bank of India balance sheet, India's oil exposures. So the balance sheet is going to be fundamentally in rupees, okay? Our accounting is done in rupees. So there you've got the other market to worry about, which is USD INR. So although technically our balance sheet is actually, what is our exposure? Our exposure is, what is our asset? Our asset is rupees. Our liability is oil, okay? We have to basically, we have to pay for oil, all right? So this is our short we are short. Our exposure is basically short oil and long rupees, because this is what we have in our hands. Okay, the RBI can print rupees, and so it's got assets of rupees and it's got liabilities in oil, in the sense it is short oil. Okay, now obviously this, when you're managing India's, going back to the idea of primary markets for price discovery. If you remember, when we discussed the idea of price discovery, we talked about primary markets for price discovery, which means where is the major liquidity. So you are not supposed to, if you're running India's oil hedging program, you are not supposed to operate like this, trying to go into the oil market and buy it against rupees, buy oil against rupees. That's not how you're supposed to operate. You're supposed to actually look at two different markets, the dollar rupee market and the dollar oil market, which is what you see here, okay, the international oil market trading in US dollars. So once again, as I said in the example of the Japanese exposure to gold, the Japanese jeweler's exposure to gold, which we discussed, if he's managing it, he should have managed it by splitting it up into the gold versus US dollar market and the dollar versus Japanese yen market. So we also have to do the same thing. We must independently manage the position here. So here we are short oil and long dollars. That should be our underlying position here, and we have to manage it accordingly. So if we feel that this is going up, okay, and we are short oil, we should buy it immediately. So we should buy oil and sell dollars. But here, we should look at a separate right. Now, we should, in this market, we are long rupees and short dollars. Okay. Now, here we may actually feel that, so that's what I'm saying, there's a separate, you have to separately look at the dollar rupee exposure. So it is quite possible that you have hedged the crude oil US dollar leg because you're worried that crude oil is going to go up against the US dollar. It's going to go up very sharply. So you quickly bought your crude oil and sold US dollars. Okay. Here you are short dollars and long rupees. Okay. Again, you have sold US dollars there. So you need to buy US dollars so that short in that market and the long in this market will square it out. And then you will actually have short rupees, which you can deliver because RBI has rupees. And then you will get your gold and you will get your oil delivered to you. So you will square your long here. When you get the oil delivered to you, your short oil position is covered. Okay. And the short INR position that you created, that is squared because you have long INR already. Okay, the RBI has rupees in its hand, and that it will deliver against this short position. So, but the point I'm getting from it, once again, this is an important principle in hedging, especially when you are when you are hedging these kinds of situations where you're either like a Japanese jeweler hedging exposure to gold prices, or managing the India oil price risk. You have to look at the primary markets for price discovery. So you do not go into the market and start buying oil against Indian rupees because you will not get good prices. This is not a smart way to hedge. The smart way to hedge is to look at what are the primary markets for price discovery. In the case it's oil, it's the international oil market in trading in US dollars. And then you have a pretty active dollar rupee market in India, okay, a currency market for dollar rupee in India. That's pretty active. So you do it this way. And as I said, therefore, these are independent views. So it is quite possible that you're to hedge the oil dollar leg. But when you look at the dollar rupee leg, where you're short dollars and long rupees, maybe you'll say that I think it's going to come down a little bit more to $70 or something. So I'm not going to buy anything right now. Right now it's around 74. So I'm going to wait to hedge my dollar exposure, dollar rupee exposure, the dollar rupee leg. That leg I will hedge when it comes to $70 rupees. But the oil leg I've hedged right away because I'm afraid the oil price is going to shoot up. So remember this angle as well, okay? This is an important thing to remember when you're looking at a hedging, when you're looking at running a hedging program. So going back to our logic, the basic idea is that the hedge position must be opposite to that of the underlying position. Okay. That is what will help you to achieve the objective of hedging. Why should it be opposite? Why should the hedge position be opposite of the underlying position? Because what is the objective of hedging? Reduce or eliminate risk. And how do you reduce or eliminate risk? You are going to reduce or eliminate the total risk. Okay, maybe we should even write it here. That will help you to understand. And what is total risk? Total risk is, we have written it somewhere else, so we can probably copy it from there, but we'll just write it here quickly. Total risk, what is total risk? Let's explain. Is the risk on, if I write it like this, you will understand. UP is underlying position, hedge, HP is underlying hedge position, okay? I think this should be good enough, you should understand. Total risk is, this is what total risk means, okay? Right. So understand the flow of logic. Once you understand the flow of logic, you will not need to memorize anything. Hedge transaction, hedge position, how to determine the hedge transaction or the hedge position, okay? Figure out the underlying position. Look at the entity balance sheet, figure out the underlying position. We have this entity balance sheet, so we'll already start looking at it. We'll discuss it maybe a little bit in detail later. Here's your entity balance sheet. Let's look at the, let's figure out the underlying position. That's what you do. We'll come to that. I'm just telling you the logic, the steps. Figure out the underlying position. Then remember that the role of, what is the role of the hedger? To reduce or eliminate risk, the total risk, to reduce or eliminate the total risk. So the underlying, and what is the total risk? The risk on the hedge, risk on the, this has to be in common, okay? Risk on UP plus risk on HP. So this should be in brackets. So the total risk, what is the total risk? The risk on UP plus the risk on HP. Okay, taken in isolation, but then you look at the total risk. So you already have an underlying position. What should be the hedge position? How do you figure out? Because the principle of hedging is to reduce or eliminate the total risk. In order to do that, you must have an HP. So this is where you get the logic. Why should the HP be, why should the HP be opposite of the UP? Because that is how you achieve the goal of hedging, which is to reduce or eliminate the total risk. You set your HP in such a way that it has the opposite sign of the UP. If the UP is long, the HP must be short. How much short? Whether equal to the full size of the UP, then you're eliminating the risk. If it is not equal to the full size, if the UP is long 100 and you're going HP short maybe 70, that's fine. You can do that. Maybe you had, that depends on whether the hedging policy allows you to do that. Okay, the hedging policy may, if you're a very, very conservative company, the hedging policy might just say, no, you can't do all that. You have to finish everything in one go. You have to just hedge and forget. As soon as I give you the money, for that you don't even need a hedging team actually, because you can just do it, because there's nothing to decide. There's no discretion to be applied. Okay, so, but that depends on the hedging policy. But most companies will have a hedging policy which will allow you to also reduce instead of fully eliminate all the time. Okay, so, but you have to reduce, you can't increase. So therefore, that's why the hedge position must be the opposite sign of the UP, because that is the only way that you can achieve the goal of hedging, which is to reduce or eliminate it. So please follow the logic. Once you understand the logic, there is no need to memorize anything. Everything will flow logically, stepwise. Now, therefore, now you know India's underlying position in crude oil is short crude oil. Therefore, the hedge, as a hedger, it must reduce its risk. Therefore, the hedge position must be long crude oil. In order to create a long crude oil hedge position, my hedge transaction must be purchase of crude oil and sale of dollars. Because crude oil trades in dollar, any market has two assets. Okay, if you buy one, you are selling the other. Okay, so therefore, India's hedging team will be. They know that their hedge transactions have to be purchase of crude oil and sale of US dollars, and of course then followed also by, well, on paper theoretically you will state the hedge position on paper you will state as purchase of crude oil and sale of Indian rupees, but you may not actually do the Indian rupee transaction leg right now. This is the leg 1, okay, and this is leg 2, okay, and this is the net exposure. Okay, so this was this is the net exposure. Short oil, underlying position, short oil, and long rupees. This is India's exposure. Short oil, long rupees. How do we manage it? We split it up into short oil, long US dollars, okay, and short US dollars, long Indian rupees. Conceptually, we manage it like this. We may hedge one leg but leave the other open. Depends on your market view. Okay, so this is how you figure it out. And then you know that if the hedge position must be long in the case of India, then the hedge transaction must be a purchase of crude oil. Purchase of crude oil, you write on paper initially as purchase of crude oil, sale of INR, but you may decide to, and then you split it up into 2 legs, but you may decide based on your market view to hedge only one. Then you have to remain conscious that the other leg is open. You have to hedge it at some point, okay? So this is how you operate, all right? And yeah, so if there's anything else here, we have to, then the hedge position, the underlying is locked. So you can just read this stuff. It's very simple. It's locked. Once you get the logic, you know what logic is. Always remember the logic. Do not try to memorize. If you're finding that something you're not able to get just by the logic, you're having to memorize, please tell me. I'll just spend 2 minutes more. All right, so your job is to tell me, read the notes, and if you find something is not following logically, it is your duty to tell me that this is not following logically. Nothing needs to be memorized, okay? But obviously, if I told you that Norway is a major oil exporter, Mexico is a major oil exporter, this is technically, it is memorized. There's no logic here, okay? You have to know this stuff. So in a way, you could say, okay, obviously you have to remember it, so it's a memorization, but you know what I mean. So it's not that, but some of that contextual information is technically memorization, but the logic is more important, okay? So please, guys, now start doing this. For the next class, we'll start looking at the balance sheet of the case, in the case. So please go into your project folder, which I will move very shortly now. I will move into your, I will do it right now. So I'll look at this and I will move it into your folder. So please now look at S Notes IFM 20, goes into the student folder. My PC is very slow. Okay, so when you please go in and then go into this folder and read the case and look at the balance sheet and try to understand the questions in the case, okay? It's a very short case, but the discussion, as you will see, will be quite long. All right, so I've moved it here. Now let's confirm that. Students, IFM. Yeah, so the notes are in there and the case is in the notes. All right, so you guys can leave. I've taken how many minutes extra? Maybe 1 minute, 2 minutes extra. Okay, all right, so the class is dismissed. Now, anybody has a conceptual question? And yes?
No concept, sir, administrative one.
You have an administrative question. Okay, 1 minute. So we'll wait.
Sir, I have a small doubt.
Yes.
Sir, actually, the part in which we were talking about the commodities, like the gold, the crude oil part.
Yeah.
So we can use it for the spot market if we want to trade. If we want to trade in the commodities, then we can use it for the same thing also. Yeah, only for the hedge thing only. The concept.
No, I didn't really understand your question. I'm sorry. Can you just?
Yeah, sir. Actually, the point where if the market will move, if the market will move up, we will be making profit, and if it goes down, we are making loss.
Yeah.
that concept we can use only for trading, matlab, we can use it only for trading also, not or is it compulsory to use that concept for hedging fund only, for hedging only?
No, that concept you can use even in the case of an active risk book, right? For trading, for so like a mutual fund or something like that, okay, or a hedge fund that you're running. You can also look at that. That's an example of what we call an active risk book, okay? What in industry is just called a risk book because they don't use the concept of passive risk book. But I've just coined these terms to help to understand better because there is a difference in the nature of these positions. So the answer to your question is you can use that logic even for trading books. Okay. So as I said, I can have a look at Aman Agarwal's option trading book, and I see that okay, this guy has short positions in Tesla calls. Okay. Then he's got some long positions in IBM puts. Okay, so I can do that kind of analysis, and I can say his underlying position in all these markets is long or short, etc. So if he needs to hedge, he can. If he doesn't want to sell off the position for some reason, that would be very unusual. Normally, trading books you don't really hedge. Okay, very unusual to hedge trading books, except for that example I gave you when we discussed the relationship between the S&P 500 and the book and the VIX, right? So, but in general, the logic can still be applied. You can look at the position and say that, okay, what is his position? If you wanted to understand, let's say, that, in the case you see that Aman Agarwal has some positions in IBM puts, but you don't know whether the position is long or short. So this logic you can still apply. You can raise the price of the IBM puts and see what happens to his P&L, his mark-to-market P&L. If you raise the price of the puts and the mark-to-market P&L goes down, then he must be short the puts. If you raise lower the price and the P&L goes up, that means he must be short the puts, because it's only the short position behaves like this. So if that was your question, that whether this kind of logic can be applied even for underlying position, the answer is yes. You got what I'm saying?
Yes, sir. Yes, sir. Thank you.
Your doubt is clarified. Okay. Anybody else with a doubt? Okay, then we can go to Vipul's.
Sir, I have an administrative doubt.
Okay, then for that we won't do the recording. So I'm just going to stop the recording and